To mute their line if they're not asking a question, you can do so by pressing *6 and unmute by pressing *7. Avant de poser une question, veuillez vous identifier. Libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur *6 et pour l'enlever, faites *7. So the first 3 questions we received are from Kim McCrail from the Wall Street Journal, Shelley Hagan of Bloomberg, and Kelsey of Reuters. So we'll start with Kim. Go ahead, Kim.
Thanks very much. If I could just begin with a question about the explicit mention that the current rate is as low as Governing Council thinks you can reduce it without causing problems in the financial system. Did you feel a particular need to reiterate that the notion that 0.25% is the effective lower bound?
There you go. Sorry, Kim. Well, we just wanted to remind people that we mentioned that that's the effective lower bound for that reason in particular. We noticed that there's still some commentary, especially in other jurisdictions, about whether, in terms of their speculation, in terms of going below the effective lower bound or going below zero. We just wanted to be current in terms of our thinking, and our thinking hasn't changed. So we just want to repeat what we've said in the past.
Thank you. And Kim, did you have a follow-up question?
I do. Yes, please. Thank you. Just another piece of the speech today, you also mentioned that you're more concerned with low inflation and potentially deflation, given the depth of the economic downturn. Can you elaborate on the concerns around deflation and how the bank might respond?
Well, this stems from the depth of the downturn. We look at how inflation is driven. Inflation is usually driven by either an upward or an increase in inflation is driven by periods when aggregate demand is much more robust than the capacity of the economy to supply goods and services. In this situation, we've been on the record in the past to say that we believe that demand for goods and services in Canada are well below what the economic capacity for them to be supplied. And as such, we see a downward pressure on inflation coming forward. In the April NPR, we had indicated that it will be, it's very likely that inflation, although it was a range in terms of our scenarios, it's very likely that inflation will be below our target range of between 1% and 3%. So given that it's below that target range, we're much less likely to see inflation above our target. We're much more likely to see inflation close to zero, and persistent deflation below zero for the extended period of time is deflation. So it's just in probability space, if you will. We're much closer to seeing periods of deflation than inflation above our 2% target. It's not much more than that. It's more that we're expressing a view where things are likely to be rather than a deep concern for deflation. Deflation is, for central banks, a much harder nut to crack in some respects, given that interest rates hit the effective lower bound, whatever that may be. They might change in different jurisdictions. Given that we have to take or make use of unconventional monetary policy tools, and those tools typically are a little bit harder to calibrate to get the right counteracting effect on the macroeconomy to bring you up out of deflation and into a more normal situation.
Thank you. So if any reporters were late in joining the call, if you have a question, let us know by sending a quick email to communications@bankofcanada.ca and we'll put you in the queue. Pour les journalistes qui se sont joints à l'appel avec un peu de retard, vous pouvez envoyer un bref courriel à communication@banqueducanada.ca si vous souhaitez poser une question et on ajoutera votre nom à la liste. So we'll now be going to Shelley Hagan of Bloomberg.
Hello. So I just read some reports that Canada Mortgage and Housing Corporation is going to tighten its lending standards to make it harder for homebuyers to qualify for default insurance. They're going to release those details later today. But what kind of impacts would tighter lending rules have on an economy during this kind of a recession?
Well, looking at past changes in terms of macroprudential rules, we've seen that usually tends to cool housing activity down. It really depends on the economic context surrounding that, and I don't have any other details on the changes to the CMHC rules, so I can't speak much more to exactly the breadth and scope of those changes and the potential impact.
Thank you. And did you have a
And
follow-up? Sorry.
Yes. Regarding what kind of further tools the Bank of Canada can use, what is the Bank of Canada thinking about deploying in the future when it becomes time to actually stimulate growth and help the recovery?
Well, we have a wide array of potential tools in our toolkit. Which we can take out of our toolkit in a sense. We've been using a whole variety of new tools that are largely been focused on the functioning of markets, making sure they function well, making sure credit flows through the financial system so that credit eventually makes its way to households and businesses. In terms of monetary policy tools that we can take out, these include tools that we've already use that I just mentioned. It just might mean that we might have to recalibrate them either in terms of scale or in other dimensions, for example.
Thank you.
Thank you. And we'll now be going to Kelsey Johnson of Reuters.
Thank you very much, Deputy Governor, for taking my questions. My first question has to do with trade. Given the trade data today that highlighted just how reliant Canada is on the United States for trade, how concerned is the bank about the impact of a second wave of COVID-19 on that market?
Well, I mean, we mentioned in my speech and in the press release, Canada is a small open economy. We worry about global economic activity more generally. And we mentioned in the press release that the rebound in global activity, including in the United States, is dependent on how the containment measures work in other jurisdictions, including the United States. So we're clearly worried about how the economic recovery globally will take off. And of course, that's dependent on how well they achieve, how those containment measures are effective and how their containment measures, over what time frame, I should say, those containment measures are reduced. To the extent that there's more fits and starts, if you will, in those containment measures, there's likely to be much more ups and downs in terms of economic growth, both in the United States and to the extent there's some other fits and starts elsewhere globally.
And then just as a follow-up, on the growth front, one of the hits that the bank has talked about a lot is, of course, the decline in energy and oil prices. I'm wondering how long the bank sees that going on for, and whether that may drag Canada's recovery, even if COVID recovery picks up quickly.
Well, I mean, as you saw in 2015, when we had the first oil price shock, it had a big impact on the Canadian economy to the extent that that oil price remains low, even though COVID measures or COVID containment measures are relaxed and the Canadian economy outside of oil it gets is beneficially impacted by the reduction in containment measures. Really will depend on what oil prices are doing, and then in that space, I don't really have a good view on what oil prices will do. Of course, currently, the oil sector was being hit hard as we were going into this COVID-related deep economic contraction. So they were being buffeted by already low oil prices and supply constraints. To the extent that those remain in place after COVID is released, these are all factors that will negatively, or if these are in better shape, positively affect the oil sector. But yeah, that's a big one of the big factors we'll be looking at as we go forward.
Thank you. And the next three questions will be from Kevin Carmichael of the Financial Post. Then we'll go on to Greg Quinn of Market News and Tony Mace of Mace News. Kevin, you can go ahead.
Hi, Mr. Gravelle. First question is really a point of clarification, I think, as much as anything from something from your speech. You pointed out that 43% of the respondents to the last LFS think they're going to return to their job, and you contrasted that with a number from the financial crisis of 15%. Just what point are you trying to make there? I mean, some Twitter wags have already pointed out that we'd still be a lot better off with the 85% who didn't think they were going to return to their jobs during the financial crisis, given the difference in magnitude of unemployment between the two situations.
Absolutely, that's a good point you raised. I think the clarification we wanted to make, and it's just more of a sort of a potential good news, is that relative to the crisis, these people who said they indicated that they're likely to return to their job, it means there's a likely have a stronger attachment to their current job and are likely to return back. So they have a feeling, or they have some discussion with their employer that makes them think that they might be, if they're laid off, be brought back. Relative to in the 2008, 2009 crisis, they didn't have that feeling, so it was much more likely that the layoffs would be permanent. But these are all sort of subtle indications, and it was just more of a hopeful sign that the attachment rate of these employees will be stronger in this crisis or this environment than it was in 2008, 2009.
Okay, thank you. The second question relates to something that keeps coming up when I'm talking to people around the potential for conflict of interest around some of your various bond buying programs. I think the one that comes up most often is the sort of the corporate bond program. Could you respond to those concerns, Mr. Gravelle? I guess you saw a need to update or mark to market your position around negative interest rates. I guess I'll ask you to do the same around your position when it comes to potential for conflict of interest around corporate bond buying program.
Well, the corporate bond program is purchase of corporate bonds in the secondary market. The aim of that corporate bond program is to enhance the market liquidity of that market. It had reached a point where it was basically quite dysfunctional at the height of the crisis in March and early April. And so we put that bond purchasing program in place to support market liquidity, the trading, the activity, reduce bid-ask spreads, indirectly reduce credit spreads. And then we set it up so that we have kind of a broad swath of bonds we buy from various sectors. We are very agnostic on the sectors we buy. We try to, in effect, we're trying to mimic the outstanding amount, the proportion of outstanding bonds per sector, per firm in a broad index of corporate bonds. So we're trying to be kind of neutral in a sense in terms of picking sectors, if you will. And we're just more focused on just having price points for the market to see and allow them to trade more actively.
Thank you. We'll now be going to Greg Quinn of Market News.
Good afternoon. Today, you mentioned that the Bank of Canada says the worst can be avoided, and there have been similar comments in recent weeks. Yet we've already lost 3 million jobs. GDP is going to fall this quarter by the most in modern records. So hasn't the worst already happened?
Well, when we talk about the worst can be avoided, it was the worst of our scenarios. So both scenarios, even the more flowery scenario, if you will, the better scenario we had in place in the April NPR was a very severe economic contraction, which reflected likely very severe job losses. What we're trying to say in our discussions here is that it seems like the more severe scenario is less likely to occur, and the slightly better scenario that's in terms of our scenario projections that we had in April NPR are more likely to occur. Not much more than that. I totally agree with you. This is a very dire kind of economic contraction, one of the worst we've seen in a long time, maybe since the Depression.
Thank you. Secondly, in your remarks, you made mention of a possible use of a rate increase to head off rapid inflation. I was wondering, is that really something that's in the cards anytime soon, or is this perhaps a jolt to markets against making one-way bets?
Well, it was more of a technical explanation about concerns for people, about concerns that people have about our balance sheet size, really, and nothing about a forward-looking statement. I don't want to speculate what we may or may not do in the future. This is more of an explanation of if the Bank of Canada has a large balance sheet, it does not preclude us from heading off any inflation pressures that may appear in the future. It's not more than that.
Thank you. So I'll remind reporters again, if you were late in joining the call, if you have a question, you can let us know by sending a quick email to communications@bankofcanada.ca, and we'll put you in the queue. And in the meantime, we will go to Tony Mace.
Hi, Deputy Governor. Thank you for taking my question. We've heard from Deputy Governor Wilkins that the bank could at some point provide funds to banks to make targeted loans to specific sectors in the real economy. Can you give us a sense of how realistic that is, and what do you think of that as an option to stimulate the economy? I mean, my other question is having to do with some broader guidance on the asset purchase program, but I guess we'll come to that thing afterwards. Thank you.
Well, Ms. Wilkins was speaking about a variety, one of our tools in our tool chest, if you will. It's called in other jurisdictions funding for lending. Again, as we said in our press release, as time goes on, as we shift our attention to more of a monetary policy concern related to in terms of understanding the use of our tools, we might be looking at the variety of tools that we have in our tool chest, and we might be bringing it out. I can explain a little bit what that funding for lending looks like. It's typically in other jurisdictions. I'm not going to speak to how we would lay it out. In other jurisdictions, it's typically central bank lending to banks like we do now in our term repos, for example. And it's conditional lending. It's lending done on the basis that those banks, commercial banks, on lend to businesses and household. That's all it is at a high level. And what was your second question?
Well, I'm wondering if you can provide us some guidance on the bank's asset purchase program for Government of Canada instruments. I mean, how long will it last? How much will you buy? Any guidance on where along the yield curve?
Right now, our large-scale asset purchases are done for a minimum of $5 billion a week, a 5-day week, I should say. It might be a little less when there's a 4-day week. And then right now, we're buying all along the yield curve. It's proportionally all along the yield curve, the purchases in the secondary market.
And how long will the asset purchase continue?
Well, we said in a variety of publications and in my speech, we're committed to doing our large-scale asset purchases until the economy is well underway, or the recovery, is well underway.
Thank you, Deputy Governor. So it appears we have no more questions on the line, so this will conclude today's press conference. Thanks to the Deputy Governor for joining us, and thank you all for joining us as well.